Hi, I am Mariana Moran, Manager at Deloitte's Business Tax Global Investment and Innovation Incentives line. Today we're exploring the relationship between ESG and tax. So let's start with the basic concepts. What's ESG and how is it developing? Let's hear from our ESG and Sustainability Assurance Leader, Panos Theodorou.
ESG defines those environmental, social, and governance dimensions or factors that measure the positive and negative externalities of both effects of sustainability risks on a business, but also of the economic activities of a business on sustainability. As you may know, the EU has set a target of cutting emissions by at least 55% by 2030, and to achieve this, they have proposed and adopted a number of regulatory initiatives. One of their key aims is to enhance transparency in the markets to support a reorientation of capital towards sustainable activities. And as such, they have proposed and adopted a number of sustainable finance regulations, and these include, firstly, the EU taxonomy, which acts as a dictionary of economic activities that can be considered as green. Secondly, the Sustainable Finance Disclosure Regulation, or SFDR, which promotes transparency of sustainability considerations in investment practices of financial market participants, and very importantly, the upcoming EU Corporate Sustainability Reporting Directive, or CSRD, which guides the application of a set of EU sustainability reporting standards, which will apply for both large and listed companies, and whose application commences on a step basis from 2024. Additionally, the EU has produced the Fit for 55 package, which is a set of legislative proposals and amendments to existing EU regulations targeting high carbon emitting industries and activities, and which also includes a number of indirect and direct tax considerations. This includes the revision of the Energy Taxation Directive in an effort to ensure that the taxation of different energy products reflects their impact on the environment and our health.
Thank you, Panos. Now let's explore the concept of tax. Is tax just an obligation, or is it also an opportunity? If we think about it, fiscal policy acts as a channel for positive impact and welfare through funding public services and goods, but also impactful, innovative private sector initiatives. See, for example, the expected financial and fiscal incentives for social enterprises in Cyprus, i.e. enterprises whose key mission is to promote a social, environmental, or cultural objective with a multi-stakeholder governance structure. So what is then the relationship between tax and ESG? Tax and ESG are absolutely inseparable. Tax fuels and shapes ESG, while ESG actions are reflected in tax results. Let's explore this in 3 points. Number 1. As organizations set out to establish their ESG goals, tax and financial incentives will have to be considered to increase feasibility options and return on investment, as well as to be aligned with policy priorities. For example, national and EU funding mechanisms will have to be considered, as well as tax incentives for environmental or social innovation, workforce mobility, etc. Various taxes that act as a deterrent will also need to be considered in order to be avoided. As you may know, a green tax framework is underway in Cyprus, focusing on the pillars of water pollution, air pollution, and waste management. Number 2, as organizations plan their net zero and social impact journey, having set their goals, value chain and supply chain transformation will likely be necessary. Restructurings may have a variety of tax implications, and paying your fair share of taxes is an imperative social and governance objective. Therefore, tax implications may affect restructuring decisions. Number 3, tax transparency is an integral part of proper governance and social responsibility. Examples of relevant questions are: do you pay your fair amount of tax according to all applicable anti-avoidance provisions, national and EU? Do you file all your tax returns, and do you comply with transparency requirements brought about by the EU automatic exchange of information rules, like the DAC 6? When drafting and publishing ESG disclosures, tax ESG standards will need to be taken into account. All in all, tax leaders and tax advisors will need to be immersed in the ESG strategy formulation, from start to finish, from planning to reporting. If you'd like to drive the conversation forward, please get in touch and we will be delighted. Thank you for your time and take care.